Your outlook for housing? Can we continue to see valuations appreciate, or is a correction on the horizon?
There's definitely a correction on the horizon in the condo space. It's ongoing. It's happening as we speak.
Only Miami, Tokyo, and Zurich and Los Angeles are running hotter, according to this ranking. I know we've talked about the fundamentals a lot, but just on a macro level, does that make sense that Toronto was fifth in the world, according to this ranking?
Absolutely. It makes perfect sense.
Let's assume this trend continues. What happens to Canadian banks? Ron, how exposed are our banks? Are we going to get a Lehman moment? Canadian Prime Minister Justin Trudeau recently met with President-elect Donald Trump at Mar-a-Lago. Trump called this a quote-unquote very productive meeting with the Prime Minister Trudeau of Canada. So what is next for Canadian-U.S. relations? How will this relationship affect the biggest sector there is, which is real estate, which affects us all? Well, we're going to be talking about the outlook for housing and real estate in Canada with our next expert, Ron Butler. He is the host of the Angry Mortgage podcast and principal mortgage broker at Butler Mortgage. We'll be talking about his outlook, assessing the valuations of Canadian real estate sectors, and talking about how Trump's presidency could affect investor sentiment. Welcome to the show, Ron. Good to see you.
Thanks very much for having me, David.
So let's start off by taking a look at this clip of Trump in an interview recently, and I'd just like to get your reaction to what he said. Take a listen.
We're subsidizing Canada to the tune of over $100 billion a year. We're subsidizing Mexico for almost $300 billion. We shouldn't be subsidizing. Why are we subsidizing these countries? If we're going to subsidize them, let them become a state. We're subsidizing Mexico, and we're subsidizing Canada, and we're subsidizing many countries all over the world. And all I want to do is I want to have a level, fast, but fair.
Is Canada going to become a U.S. state, Ron?
It's just pure nonsense and craziness. There's nobody in the Republican Party would ever want Canada to be any part of the United States. We would be relentlessly and consistently 80% blue votes. And we would probably assure a Democratic Party majority in all houses and in the presidency for eternity. It's just complete fantasy. Never going to happen. It's Donald Trump being Trump. I mean, anybody who thinks they should carefully analyze every word out of his mouth, their head will explode if they want to continue to do that. That doesn't make any sense.
I think the broader topic here is that Trump does want to impose tariffs on China, Canada, Mexico, a bunch of other trading partners around the world. He's doubling down on his tariffs that he imposed in his last presidency. Trade wars affecting Canada. How will that affect investor perception, capital flows in and out of the country?
Well, investor perception in Canada, that ship sailed. That ship sailed a long time ago. In real estate, we have zero interest from other companies investing in Canada. In almost every sector of our economy, foreign investment is completely flat and disinterested. Sure, if the level of tariffs that Trump is suggesting occur, it's probably a 3% drop in our GDP. But as far as investment's concerned, Canada's taken care of driving out investment already. We've done it all by ourselves.
The conversation today is focused on Canadian real estate, but you said that the economy, regardless of whether or not Trump is going to implement tariffs, is already on a decline, which could impact real estate. So tell us about the Canadian economy. What is your outlook?
My outlook is continuous growth in unemployment in a kind of Ontario-led recession, where Ontario is already at a 7.6 unemployment rate. I think we'll definitely see that break into the nines at some point in 2025 in Ontario. Canadian unemployment will continue to rise. The construction industry in Ontario is facing a kind of complete collapse over the next 24 months. And manufacturing has lost 20,000 jobs here in Ontario just in 2024 alone. So the future is dim as a recession being led from Ontario.
Are we seeing housing prices reflecting this data in real time right now?
Great question. We have seen an absolute catastrophic problem developing in investor-driven condominiums in 416. It is far worse than Vancouver's issues. Vancouver has issues, but Ontario is the epicenter of an unmanageable pricing problem. We have brand new products coming on the market, which has been 5 or 6, or in some cases 7 years in development. This new product is priced so grossly higher than resale products right across the street. We have a building with a $1,400 a square foot. That's the price that people paid, and they're expected to close next year. $1,400 a square foot. The building across the street from them, which is 3 years older, has a resale product at $900 a square foot. The delta is completely unmanageable. These products were purchased 5 or 6 years ago. These tiny condos were purchased by investors 5 or 6 years ago with some absolutely ridiculous assumptions. The assumptions were, much in the case of the Dutch tulip bubble, that prices would simply go up eternally and forever. Another assumption would be that 2% interest would continue forever, and that mass immigration would continue forever. All of these things have become untrue, and the feasibility of even closing on these condominiums, and there's about 35 to 40,000 of them coming on in the next 12 months, is doubtful. In fact, doubtful. Some will close, many will not, and it's a version of catastrophe. Now, how does that spread out into the rest of the condos? How does that spread out into single family? Well, we're watching it impact the other condos right now. There's been a steady drop in price per square foot sales on resale. No one really knows where the floor is. And there will be not much spillover into single family for this critical reason, both in the lower mainland of British Columbia, Greater Vancouver area, and in almost all of Southern Ontario. The development of single family low-rise homes started falling off a cliff back in 2017, 2018. Very few low-rise compared with high-rise. The ratio ended up at about 80-20. So we're actually developing scarcity amongst single-family homes.
Before we continue, I want to tell you about a recent data breach that exposed nearly 3 billion records in one of the biggest data breaches ever. This case highlights just how vulnerable personal information can be in today's digital world and the importance of protecting your privacy online. That's where Delete Me, today's sponsor, comes in. Delete Me removes personal information like your address, phone number, and more from hundreds of data broker websites. It's a service I trust because it makes staying safe online simple and effective. Using Delete Me is easy. Submit your information, and within 7 days, you'll receive a detailed privacy report showing where your data was found and removed. Plus, Delete Me keeps monitoring and removing your data all year long for ongoing protection. Head over to the link in the description down below and use the promo code DavidLynn at checkout, or simply scan the QR code here on the screen to get 20% off on all U.S. plans today. Thousands are already relying on Delete Me to safeguard their online privacy, so start protecting your personal data and information now. I want to drill down a little bit deeper on these stats, but before we do, let's back up for just a minute for our viewers here who may not be familiar with the Canadian housing market, because a lot of my viewers are based in the U.S. How do we get here, Ron? Take a look at my screen. This is the home price index, inflation adjusted of G7 countries, put together by this Twitter channel here, source from the Federal Reserve. Now, if you see here on the chart showing the price index, inflation adjusted, Canada leads the other OECD countries by valuations, by considerable measure, by home prices. And so this trend has been intact for quite some time. Canada is not getting richer compared to its peers. In fact, if you look at articles like this from CBC, Canada is getting poorer when compared to its wealthy peers, data shows. Canada is among the richest countries in the world, but when compared to peer countries like Australia, New Zealand, and the UK, it isn't as rich as it once was. Wealth gap between Canada and the US has only grown wider, according to the OECD. How is it that the Canadian population overall is getting poorer relative to its peers, but the housing market is getting more expensive?
There's such a wide range of answers to the why Canada is getting poorer, but I could more easily address the real estate issues. Okay. The real estate issues revolve around the fact that in 2008, 2009, when the U.S. went through a wrenching reduction in house prices and a catastrophe in their mortgage market that spread out across the entire world, we even refer to it as the Great Financial Crisis, the world financial crisis. That lasted for us about 10 months. I mean, there was a brief correction, and we were effectively back to normal by the end of 1 year, followed by the zero interest rate program. So we had interest rates that were lower than inflation for the best part of 13 years, culminating in the total catastrophe of interest rates going to zero in the COVID times. So we had we were selling fixed rates for 5-year fixed rates for 1.49%, and we had variable rates for 0.99% in some cases. So it's unheard of interest rates, and that fueled, combined with a high level of immigration and a constraint on supply in some cases through various legislative means through both British Columbia and Ontario, a constraint in supply, which led to astronomical prices being sold in 2020 and 2021. So yeah, it was a made in Canada bubble, which is coming off now, but it's essentially that: incredibly low interest rates, a aggressive immigration policy, and constraint on land itself. Like we have a green belt in Ontario, which basically limits the development of housing in a severe way. There's geographical constraints in the Lower Mainland, which we are all aware of. There's oceans, mountains, and rivers, and there's only so much land to go around. But in Ontario, it's an entirely legislative creation of scarcity. But that's the story: incredibly low interest rates, fueling an astronomical run-up in prices based on immigration and, in some cases, foreign capital.
The government has tried to help this issue with a few measures. One of them is additional taxes on foreign investment. For example, foreign buyers are now levied to an additional tax, especially in BC, where I live. How effective have these measures been? The Conservative Party has been consistent in criticizing the Liberals in not managing this affordability issue, despite attempts at raising taxes. Were they effective?
Well, the foreign buyers ban, the foreign buyers taxes are profoundly ineffective, because the reality of these programs is that the people who are receiving money from overseas are currently permanent residents or citizens. I mean, they've come over here from other countries. They've gained their citizenship, they've gained their permanent residence, and the money comes from Iran or from China or from another country. It flows from their parents or their relatives to them, but they're not foreign. They are citizens of Canada, or they're permanent residents. So that's where the unchecked growth of some of this foreign capital came from. So a foreign buyers ban today is particularly pointless.
Okay. You mentioned immigration as another source of the supply gap that we're experiencing. As you know, Canada has experienced a large influx of immigrants in the last couple of years. In 2023, I believe over 1 million immigrants came into the country. That represented 97 or 98% of the Canadian population growth overall. The government has recently announced that they want to curb immigration going forward. Do you think then demand for housing is likely to slow down a little bit in the future?
Well, it's going to become a tale of two products. So the condominium, the small condominium market is going to turn into a glut in major cities in Canada, and single family, which has been so constrained. In fact, in Ontario, we suspect that the development of single family homes in 2024 has just fallen off the face of the earth. We're thinking it would be less than 10,000 homes, maybe less than 7,000 homes on a low-rise basis. This is just the facts of life in Canada. There's no financing for development available for single-family homes, and the big builders of single-family homes in Ontario and in British Columbia all stopped building them about 12 or 14 months ago. They sold what they had pre-sold, and they closed their sales offices. So that's the case we're faced with today. There is going to be eventually, strangely, in a country where the government has promised 3.1 million new homes by 2031, we're going to find that we're down to about 180, 190,000 starts next year in 2025. It's that bad. So the starts are going to decline radically.
So given the supply and demand fundamentals, your outlook for housing, can we continue to see valuations appreciate, or is a correction on the horizon?
There's definitely a correction on the horizon in the condo space. It's ongoing. It's happening as we speak. There is a correction on some erratically overpriced houses in the far reaches of the Fraser Valley and within the 905 belt of Ontario. These corrections have already largely come in, and some of them are quite significant. In some cases, as much as 30% price reduction in the 905 around Toronto and in the far reaches of the Fraser Valley from the 2021 peak. So these things have already happened. But in terms of a great repricing of single-family Canadian real estate, it's quite unlikely in British Columbia and Ontario, because the reality is that it's been constrained for the last number of years. New construction has been radically constrained.
Can you comment on the disparity of prices across Canada? So I currently live in BC and Vancouver. I've also lived in Montreal. I spent 14 years of my life there. And I've looked at Canada Housing or Canada Mortgage and Housing Corporation data. Consistently over the last 20 years, the Canadian housing market, if you take a look at single-family homes, has been triple the Montreal price. And if you look at StatsCan, the household disposable income in BC is not higher than in Quebec. So, you know, how is it these markets are so widely varied in prices and valuations?
Another great question. The reason in Ontario and in Toronto and Vancouver, you have to roll back about 10 or 12 years to a vast influx of international capital buying properties in those two cities. The same level of interest never existed in Montreal. There was never a massive interest in people from Eastern Europe or from Iran or from the Middle East or from China to purchase residential properties in Montreal. Very important to understand that Quebec is the only province that has their own control of immigration. None of the other provinces do. But in Quebec, they only have to take 50,000 new immigrants a year, compared with, in some cases, Ontario taking 400,000 in a year. So that is a radical difference. There's never been a requirement for Quebec to have the same level of immigration that the other provinces have experienced. It's been well controlled. All the complaints you hear out of Quebec about immigration today are strictly to do with refugees, of which there's less provincial control. But in terms of actual permanent residents, no, they have the lowest influx of all large provinces.
What does that tell you about real estate as an investment vehicle? Presumably, if you're a foreign buyer, if you're looking for bargains, you would pick a jurisdiction like Montreal that's a third or half the prices of Vancouver or Toronto for a similarly priced condo or house. But that doesn't seem to be the case over the last couple of years.
You know, the barrier has largely been a language barrier. There's been a disinterest in having to work within the Quebec culture for a certain class of immigrant. There's also been a disinterest in the general tenor of their immigration policies. If you restrict it to 50,000, and of those 50,000, the majority need to be French speaking already, then you've just modified your immigration profile to the point where some of those investors just won't come here, won't come to Quebec. Now, your point's well taken, and there's actually been a significant increase in Quebec house prices and building activity in the last 14 months. So if you, by definition, Quebec's real estate market today is on fire.
Interesting. Let's assume that you are right and that we do see a correction in the housing market for condominiums. By the way, it's already happening in Vancouver. I've been seeing real estate pamphlets getting sent to my mail, and downtown Vancouver is down, according to this pamphlet, 20% in sales volume, 8% price year over year in 2023, 2024. But let's assume this trend continues. What happens to Canadian banks? Ron, how exposed are our banks? Are we going to get a Lehman moment?
Oh, no. Nothing's going to happen to Canadian banks. These are the most, excuse me, I was a little cold today. Nothing's going to happen to Canadian banks. They have limited exposure to the development side of the condominium world. They are well placed in, I'll give you a simple example. Look at their default rate. They all reported last week. Their default rate has only risen to about 23 basis points of 90-day mortgage default. This is so much lower than what's considered normal in the United States. Normally, the United States is considered about 36 basis points of 90-day default. We still run much better than many other countries in terms of residential mortgage default. We're one of the market leaders in the world. So I don't think the banks have too much to worry about.
Okay. Moving on to rates now. Take a look at my screen here. This article came in recently. Three major banks are raising mortgage rates. CIBC, Royal Bank, and TD raised their 3, 4, and 5-year fixed rates by 15 to 35 basis points. Just another note for our American viewers, or Canada doesn't like to use the 30 and 35-year fixed products. So we have 3, 4, and 5-year fixeds. So they raised rates while at the same time the Bank of Canada is lowering rates. We'll talk about that in just a minute. But why the divergence here? There
was a significant upswing in the last 7 weeks, but which ended 10 days ago. We've had a retrace of 40 basis points from that article. There was about a 75 basis point run up, which has now come down about 40 basis points. Much of this does react to the Trump effect. There's movement in the 10-year bonds, in 10-year treasuries in the United States. Treasury yields have had a bit of a run up. They've now had a distinct slide. Our own bond traders clearly feel that the Canadian economy is expecting more decline, worse outcomes in 2025, and the bonds have reacted accordingly. We very much will eventually, at some point in 2025, come to an agreement. We are in some form of recession in Canada.
I think for a lot of my personal friends have been asking me, when do you expect rates to come down? When do you expect a buyer's market to reappear for the Canadian housing market? Obviously, it depends on where they live and what they're looking for. But this is an interesting piece of development because rates aren't really coming down dramatically. How would you go about answering that question, Ron?
Well, variable rates will come down dramatically. There'll be an announcement where there will be a cut of either 25 or 50 basis points. There will be continuous cutting next year by the Bank of Canada. I think the Bank of Canada is quite willing to sacrifice the currency to radically reduce the Bank of Canada rate to somewhere between 2.5 and 2.75 by the spring or early summer of next year. So people taking variable rates will end up with a rate that's sub 4%. It'll be 3.95. It'll be 3.7. Fixed rates are normally always slightly in excess of variable. That's been the history of it. It changed when the Bank of Canada ran the rates up dramatically to fight inflation. But historically, there's always been a delta of somewhere between 25 and 75 basis points in favor of variable rates. And I think we'll see that come back. We will see fixed rates fall. Fixed rates fell as low as 3.99 for 5-year fixed, just as recently as October and November. They're back up now, but I think we will see them come down again in the late spring.
Yes, and on that note, it's expected that a 50 basis point cut by the Bank of Canada could happen this week. We're speaking ahead of the Bank of Canada decision this week. Ron, what effect does this have on transaction volume if we see rates fall?
Well, we've seen transaction volume increase on resale. As I say, nothing can really help the new home market, the new construction market, but we've seen the effect on resale both in Vancouver and Toronto in November and October, where we saw a decided increase off very lackluster numbers. We're still talking about 10-year lows, but they are actually picked themselves off the floor of 27-year lows in those centers, and there was increased sales activity in October and November. I suspect when we see a further reduction in the new year, there will be a continued upswing in resale activity in terms of total unit numbers sold, but again, it will likely stay below 10-year averages.
Looking ahead now, Ron, can you comment on what Prime Minister Justin Trudeau has said in a tweet recently? He said that there are more than 200,000 short-term rentals across the country, like Airbnbs or VRBOs, that could be turned into housing. So we're giving cities more resources to crack down on those rentals and unlock more homes for Canadians. He said this on his X account recently. What's your take on the government's attitude towards short-term rentals and how they plan to crack down on these?
It's another nail in the coffin of these tiny condos. Another set of bad news for these rental investors who are using them as Airbnbs. In the province of British Columbia, short-term rentals like Airbnb are effectively outlawed at the provincial level. In Montreal and Toronto, they're effectively illegal with very limited licensing on the city level. What the Prime Minister is referring to is increased enforcement and penalties that may be available through the Tax Act in the coming year. The reality of the future for Airbnb for just investors, for people who want to rent a condo like a hotel room, is very bleak and will continue to be worsen throughout the course of 2025. And the original purpose of Airbnb, the stated goal of Airbnb, was to allow people to rent out rooms in their homes to vacationers. And that quickly, almost instantly morphed into buy a condo and rent it out like a hotel room. But cities and provinces have come against that. And the Prime Minister is indicating that he will give more CRA tools to allow people to be more punished for maintaining these Airbnbs.
And then let's close off with comparing cities. That's a good segue. So here's an article from the Financial Post. UBS ranking. This is research from UBS. Toronto ranks 5th in world for risks of real estate bubble. It further goes on to say that cities with scores above 1 are considered an elevated risk, while scores above 1.5 are high risk. Toronto's score fell from 1.21 in 2023 to 1.03. Elevated risk. In Vancouver, on the other hand, home prices are higher, but income growth has not increased as much, while rents have risen sharply, but UBS says is now considered a moderate risk. So Vancouver, less of a risk of a bubble burst than Toronto, according to this report. Do you agree with this assessment overall?
It's an accurate assessment. Vancouver has had fairly stagnant pricing for in real estate for the last, I'd say, since 2017. Therefore, it's not as big a risk of a bubble. Also, again, constrained by geography. There's only so much you can do in Vancouver. There will be problems with condos, as you have indicated, and that will continue to be true. But in terms of the total real estate structure of the city, it's in some ways it's low growth. And now that condo construction has slowed down dramatically, it will continue to be low growth. Which takes away some of the aspects of the bubble. The bubble in Toronto, it's real for the condominium developers. It's very real, and it's a work in progress. We're watching it happen in front of us.
Yeah.
In terms of other parts of the resale aspect and the low rise and single family detached, less vulnerability because the creation of the product has been so radically cut back. There's actually a level of scarcity that's come into play.
It's people don't typically think of Canada as a bubble. People who may not be familiar with the market. I mean, if you look at this headline, only Miami, Tokyo, and Zurich and Los Angeles are running hotter according to this ranking. I know we've talked about the fundamentals a lot, but just on a macro level, does that make sense that Toronto was 5th in the world according to this ranking?
Absolutely. It makes perfect sense. There's so much exposure to the condo market. And if you're looking at the totality of value depreciation that has a potential to occur in the next 2 years, it's very real. And it will impact on the average pricing because even though it's a very specific residential category, it will impact the totality of the price effect in Toronto. There's no question about it.
Okay, final question, Ron. Can you comment on this change in policy here? Minimum down payment for a $1.5 million home in Vancouver will be $125,000 after December 15th. Down payment breakdown. I think down payment rules are changing. Can you comment on this change?
Yeah, down payment rules have changed. They're coming into effect in just a few days. The important thing to understand about this, though, is you still must qualify for the mortgage. There is still a stress test in place through the bank regulator that makes you qualify at a rate that's 2% higher than the actual rate you're getting. The outcomes of all these things are that to qualify for the maximum home value of $1.5 million, using the small down payment, you require a family income of $340,000. So the reality of who has that income, no, that's a very small number of people. So the actual, the event itself sounds interesting, but the reality of being able to use it is very small.
What's the rationale of changing this from the government's perspective?
The rationale?
Yeah, why are they doing this?
It's purely political.
Okay.
It's 100% political. I mean, we're having a GST holiday for 2 months that's going to cost retailers about the price of the whole GST holiday. We're also funding it through a deficit of about $2.5 billion. Everybody agrees totally that the GST holiday is insane, but the government has the worst polling numbers in 30 years, so they have some work to do.
You don't think that this minimum down payment reduction is going to turn some of the markets around, make it hotter a little bit? No?
$340,000 family income. That is not growing on trees.
Okay.
And
fair enough. Ron, great talk. Tell us about your work. Where can we find you?
ButlerMortgage.ca, Angry Mortgage Podcast, very active on Twitter and other social media platforms as Ron Mortgage Guy, and very, very interested in the unfolding events of the Canadian real estate market and the Canadian mortgage market.
As am I, and as we all are. Thank you very much, Ron. We'll put the links down below, so follow Ron there. Pleasure. We'll speak again soon.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.